A halftime report. Well, one of the key charges made in the Hindenburg report about the Adani Group is that the stocks are seriously overvalued as of January 24th. Lata caught up with a stock valuation expert, Professor Aswath Damodaran of NYU Stern, to discuss in detail about the Adani Group valuation picture. You want to listen to this one. She began by asking him about his recent blog, where he values Adani Enterprises at 945 rupees and his assumptions on the Adani Group. Listen in.
What I see in the Adani, I mean, forget about all the Hindenburg Group, all the stuff in that report. What I see in this business is a company that invests in infrastructure investments, which have long gestation periods, require huge capital expenditures upfront, and are not that profitable. It's the nature of the business. So when I approached the valuation of Adani Enterprises, that's what I brought to the game. I had to bring in the fact that this is not a business that can generate 30% margins or 40% margins. You're going to be lucky to get to 6 or 7% margins. The global average for infrastructure companies is about 4.8 to 5%. So at 7%, I'm already pushing the limit on what those margins will be. And even if you assume that they can continue to grow at the torrid pace that they've maintained for the last couple of years, there are only so many airports you can build, so many ports you can construct, so many infrastructure investments you can make. So I thought I tried my best to bend over backwards to make optimistic assumptions, but I had a tough time getting past 1,000 rupees, 1,200 rupees per share. So that was, and that was where they were trading before the last 18 months. I don't know what the ratchet was that caused the price to jump as much as it did. But to me, at the 3,800 rupees it was trading at the start of the year, I just can't get there with the kinds of businesses they're running.
Okay, so you have assumed 7% margins and 25% revenue growth, because that was the growth between 2002 and 2015, you point out.
I actually give them 30% revenue growth for the next 5 years. I actually assumed that there'd be part of it is from existing reinvestments starting to pay off, and infrastructure investments take a while to pay off. So I actually gave them 30% revenue growth for the next 5 years and pushed the margins over time to 7%. Right now, they're at 3.6% margin, so that's almost a doubling of the margins.
Okay. I believe they also have shares in some of their subsidiary companies. Would that add some more to their value?
You know what? They're all in the same boat, right? All their businesses outside of the food business are the same kind of business. In fact, you got to give the Adani Group credit. I mean, this is not the kind of business that most companies want to be in. It's a messy, long-term, capital-intensive business, and it's almost like the Adani Group. That's their focus. It's on those types of business. So you take port, you take power, you take energy. Every single company shares exactly the same characteristics: big investments, capital-intensive, low margins.
Okay. Yeah, fair enough. And much of this, as you point out, has been built on debt. You point out that percentage of net debt is 91% of the capital, and percentage of equity is just about 8.7 in the first 15 years, 2002 to 2015, actually. So
that's a new
will that come to bite?
It's not a debt ratio. It's the amount of new capital they've raised has been almost entirely debt until the last year and a half, whether driven by lenders' concerns or the fact that the market cap was so high. They used a little more equity in 2021 and 2022, but this is a company that's been reliant on debt for their growth. I mean, there's an old saying, what a tangled web we weave, and I won't finish the sentence, but I think control has driven the company to do things that you look at and say, why would you want to do that? The answer is, this is a group that values control over almost every other objective in the company.
Okay. Since you say that you're not able to support the price at, the kind of current valuations, what would your advice be if you were asked to the MSCI, to other indexes? They are in the Nifty as well. Do you think they should not have been included in the index in the first place?
No, I think MSCI should do whatever the market. If the MSCI started valuing companies, we'd be in big trouble. Those guys couldn't value a $20 bill in a brown paper bag if you put it in front of them. So I think they should take the market cap. It's not their fault that the market pushed it up. I would have an issue with the kind of unquestioning bullishness that's gone into pushing the price up. I mean, this is not a retail stock, so you can't blame retail investors. But there's something that's pushing the price up with no counter on the other side. And I think that's concerning when you have this. I mean, this isn't a tech company, a young company. We should see a ratcheting up of the price as much as you did in 2021 and 2022. So that is troubling to me that the market would let the price go up that much for a company that you look at and say, that company, you shouldn't see this much of a jump in the price over a short period.
Okay. Who do you think should have blown the whistle? You think it should have come from the regulators, from the capital market regulator?
You know what? We get the regulators we deserve. I mean, much as Indian investors like to complain about regulators, they've been on a bull run where they really haven't wanted the regulators to stop them from making money. You know, I find Indian investors start to talk about regulators only when they lose money. Regulation cuts both ways. So I think that, you know, we need to accept the fact that investing comes with risk, especially in equity, that losing money is just as much part of the game as making money. And we can't keep running to regulators every time we lose money, say, save us from our own mistakes. So I think that in a sense, we're assigning to regulators powers that they cannot bring to the game. They cannot protect us from our own greed and our own mistakes. And I think sometimes people need to make their own mistakes to learn the lessons. In this case, they're going to be institutional investors who learn the lessons, green bond holders who will lead you know, those are the lessons you need to learn in marketplaces.
Okay, and don't miss the